The average investor could lose £1,200 a year through investment fees. How easy is it to compare them?
Unfortunately, there's not much that's free when it comes to investing. You might not think, 0.1% it will actually matter that much, but really it can add up. It's a fantastic bit of maths, really. You don't always get what you pay for. They could be one-off fees, regular fees, management charge or an account fee, trading fee or a transaction cost. Fees can compound as well, and every £1 you're paying in fees is obviously £1 less for you to earn a return on. That's a difference of £4,000 just for making a different choice.
Well, it's safe to say this is a subject investors need to stay on top of. You ready, Michelle?
Let's do it.
So let's start with platform fees.
Unfortunately, there's not much that's free when it comes to investing, and the charge that people will probably expect to pay is a platform charge, and that's also known as a management charge or an account fee. And if you're holding your investments in a pension or an ISA, it will be known as a pension charge or an ISA charge potentially. And this is the basic cost of using the platform and all the resources that it will offer you, such as fund insights and updates, things like that.
So fees are going to differ platform to platform, but how easy is it to compare them?
Well, it would be great if we had a comparetheInvestmentPlatformFee.com website, but unfortunately we don't. So investors will have to do a bit of their homework themselves. So as broadly speaking, there'll be either a flat rate fee that they'll have to pay each month, or the fee will be charged on a percentage of the investment that the investors put on the platform. If it's the latter, if it's the percentage charge, then the broker could put in a cap, so the top end that you'll pay regardless of how much money you invest, but they also might not. So that's something you just really need to be aware of.
But how significant can the differences be?
Well, you might not think, 0.1% it will actually matter that much, but really it can add up. So obviously the more that you pay, the less the money that you have as your return. So whatever you're paying is kind of eroding, the money that you get in your pocket. And also you have to remember, platform fees aren't the only fees that people are paying. This is the base fee that people will pay. And if you're on a platform, it's likely that you're going to want to buy shares, you're going to want to buy funds, so they all come with their own charges too. So you just have to be aware that those numbers will start to stack up, and that 0.1 could seem quite significant by the end.
So let's move on to dealing fees. Talk to us about those.
So dealing fees are the second level of fees that you pay on the platform, and they could also be known as a trading fee or a transaction cost, and they're paid when you buy or sell funds or shares on a platform. And also that you'd pay those depending on the platform. It could also vary, that dealing fee. It could depend on what type of investment you're putting your money into.
Yeah, so talk to us about the array of investments available to investors.
So platforms offer a huge host of investments, so sort of thousands and thousands all across the world, and you could maybe use them to buy individual shares in companies, which are also known as stocks or equities. You can use them to buy funds, which are managed by fund managers, where you give your money over to a professional who hopefully knows more than you or I, or that the investor does, and invests the money for you. Or you can buy funds that aren't actively managed by a manager and that they track an index or a stock market, and they're known as trackers or exchange traded funds. Or there's also another type of investment called an investment trust, which is a specialist fund really. It's a company that's listed on the London Stock Exchange.
So all of these investments incur dealing fees?
Wherever you invest, unfortunately, you will have to put your hand in your pocket. You will have to pay a dealing fee, unfortunately. I mean, and the thing is, you have to remember, if you're a person who likes to trade a lot, you've got a really keen eye for the stock market, you really want to be active in your portfolio, those dealing fees are going to go up and up and up. You're going to pay more every time you deal. So it might be a good idea to look for a platform that's got either a flat rate for dealing fees per month, or that offers you a reduction the more that you deal.
But how about the fees for investors that aren't necessarily looking to invest in individual equities, but actually want to invest in actively managed funds?
Yeah, you're right there. Not everyone is keen to pick their own, stocks and companies. I mean, very few of us have the time or the skill to do that. So obviously you can give your money to a fund manager, and they are hopefully an expert at picking the stocks that are going to go up, and they will invest that money for you via their fund.
So what factors determine the fund fee?
Yeah, of course there's with everything there is a fee for investing in a fund, and fund management is a lucrative business. But as an investor using a platform and investing in funds through that platform, there's two factors that are going to affect your fee. The first is the fund fee set by the fund management group who run that fund, and also the second factor will be the discount that the platform's managed to wangle. So you could end up with a scenario where you've got a platform that's offering you quite a high platform fee, but it could offer you a lower fee than another platform on a fund that you want to buy because it's managed to get a bigger discount.
I guess fees are going to differ between funds and between providers. What should investors look out for when investigating those fees?
It's true. Fund fees will always be variable, and I mean the thing is as well, you don't always get what you pay for. Just because a fund fee is really, really high, it's a very expensive fund, it doesn't mean that the performance is going to be stellar, that the fund manager will knock it out of the park every time. So your best bet is to really look at the performance of that manager, of the track record of that manager. Of course, they always say that past performance isn't an indicator to future returns, and that's true. But you should be looking at how well the fund manager's done, and then see if you're comfortable paying that potentially high fee.
But there's another set of fees people have to be aware of, right?
You've guessed it, fund managers do want paying, and it's a very lucrative business. But thankfully for investors, there's an easier, slightly easier way to understand fund fees, and that's thanks to the ongoing charges figure, the OCF. And under the regulatory standards, fund management groups have to disclose this. And this is a total charge that you'll incur, and it includes the annual management charge plus the dealing charges that the fund manager pays in the fund.
But that OCF isn't necessarily directly reflected in the platform, I think I'm right in saying.
Yeah, you're totally right. And they stand to two factors, basically. The fund fee that you'll pay on platform as an investor might be slightly different to the OCF that the fund manager charges on their website. And that's due to the discount that the platform can possibly wangle with the fund management group. So that means that they'll get it at slightly reduced rate for the investors that invest through their platform. And this means that if you're looking for a platform to invest your money in, and you've got a real idea of what fund you want to invest in, you might find yourself looking at a platform that has got maybe a slightly higher platform fee, and that's because it offers you a bigger discount on the fund that you might want to put your money into. So that's even though the platform charge might be higher, depending on where you want to put your money, it might be worth looking at that.
Yeah, absolutely. And in terms of how those fees differ fund to fund and provider to provider, are there factors that investors should look out for?
100%. And what you have to remember when you're investing in funds as well is you don't always get what you pay for. Some funds do have a really, really high charge, a high OCF, and that doesn't mean that automatically that fund manager is a star fund manager who's going to knock it out of the park all the time. They could have a really bad track record. As an investor, it's up to you to do your homework, look at the past performance. Obviously, it's not a given that performance will carry on in the future, but it is a good indicator. So make sure you're doing your homework, looking at the track record of the fund managers you want to invest in before you're putting your money with them.
But some funds incur performance fees. Talk to us about those.
That's true. That is a very sneaky, hidden fee, if you like. Performance fees, not all funds have them, and they should be upfront with you about them if they do have them as well, but they can be quite significant. And performance fees are basically an extra kind of charge, if you like, if a fund manager hits a preset hurdle for returns. I mean, they're not, you will obviously have to pay it, but it's not all bad news, because if the fund managers hit that hurdle, it means that the return is probably pretty good on the fund. But it's whether you weigh up whether the return versus the performance fee is something that you're willing to pay and that's something that you're comfortable with.
We've discussed the main fees investors will be subject to, but I think we alluded earlier on to hidden fees. Let's talk about those now.
Yeah, definitely. There's a few hidden fees, if you like, and they could be one-off fees, regular fees, but all of them, they're not going to be obvious. So it's worth running through them really. The first one could be an account opening fee, which is pretty self-explanatory. When you take out your account, you may have to pay a fee. There could also be a withdrawal fee. So say, you're investing away and then for whatever reason you need to dip into your investment pot and take some money out, you could be charged for that. You could also suffer a dividend investment charge, and that means if you're investing in funds or shares that pay you a dividend, pay you an income regularly, but you don't need to take that income for whatever reason, you want to just put it back into your investment pot because it does boost it in the end of the day, then you could be charged for reinvesting that dividend back into your portfolio. And you also might be charged a fee if you want to change platform as well. So maybe you want to move your investments to a different platform, or you want to switch ISA, you could then incur an exit fee.
Absolutely, and let's not forget FX fees. Investors will be subject to paying Forex fees. So they differ platform to platform, of course, but if an investor, for example, chooses to invest in a stock listed outside of the UK, they'll need to pay a fee to transfer any returns they make from dollars, for example, back into sterling. And it's a really important thing for investors to remember.
Yeah, definitely. That sort of switching from currency to currency can cost them an awful lot. So that's definitely worth looking out for when you're choosing your platform.
Absolutely. So why is it so important for investors to be in the know on fees?
Well, if you're using an investment platform, the chances are you want to make money and not lose money. And it's not just tricky markets that investors have to navigate, it is this whole host of fees. And they can really add up and they can really take a chunk out of your hard-earned cash. And the problem is it's really easy for them to rack up quickly. And the other problem is that that high fee will matter more and more over time as well.
Well, absolutely. If they're investing over the longer term, compounding is going to have a significant effect. Talk to us about that.
Exactly. Einstein described compounding as the eighth wonder of the world, which is quite high praise. Basically, what it means is when you invest your money, you're making a return. And then as you invest more and more and more, you're also making a return on those returns. So the return you get is on a larger and larger pie. So, it's a fantastic bit of maths, really. So that's great when you're calculating your return, but also fees can compound as well. And they'll reduce and eat into your pot over time. Every £1 you're paying in fees is obviously £1 less for you to earn a return on.
Well, it's safe to say this is a subject that investors need to stay on top of.
Definitely.
Now, let's get into a real world example to make this a little less abstract. Let's say we've got two investors. Investor A has paid just 0.5% in fees, whereas investor B has paid 1.25%. Let's say he's not done his research and he's less concerned about fees. Now, they both invested £10,000 over 20 years, and let's assume a rate of 5% return, excluding fees, of course. What are the implications for both of these investors?
Now, this might seem like it's kind of a simple bit of maths for us to do, and it's from the Money Advice Service, but it really shows, just how much of a difference fees can make. Now, at the end of that 20-year period, our investor who, didn't do their homework, if you like, and paid the higher rate of fees, they're going to have in their pot just under £21,000. Our investor who wrangled those fees right down, who knuckled them down, they're going to have just over £24,000. That's a difference of £4,000 just for making a different choice and and doing your homework. And I think that's a huge sum that you can save. Of course, if you're investing more, the saving will be even larger, or the loss.
So if there's one thing investors should remember on the subject of fees, what's the key takeaway from today's discussion?
Unfortunately, there's no, optimum level of fees that you should be paying, but there's two things that you should really think about before you pick any investment platform. The first one is how much money that you can afford to invest each month. If you can afford to invest quite a hefty sum of money, you don't want to be paying a percentage of that over each month to the investment platform. You'll probably want to settle on a flat fee. And secondly, you need to decide how much you're going to tinker with your portfolio. If you're going to be, in and out of funds, in and out of shares, you decide you want to, be your own fund manager there. Brilliant, but the dealing, charges are going to hit you as well. So just be really careful. Each investor is individual. Each portfolio is individual. You just need to work out what's best for you. Go onto the investment platform's website. Try and drill down into how much it's going to cost you. Do your homework. Make a good decision.
Thanks so much, Michelle. It's been a fascinating discussion on fees. We've covered platform fees right through to dealing fees and how exactly that impacts an investor's portfolio. Join us next time where we'll be discussing rebalancing a portfolio and the impact that can have on investors' returns. Thanks so much for watching.